Hello and welcome back to Only Pay. We'll be discussing about assets and liabilities. Be sure to watch all the way to the end. If you are new to the channel, then hit the subscribe button below for more life-changing content. In its simple form, your balance sheet can be divided into two categories, assets and liabilities. Assets. Assets are everything a business owns. They are found on the left side of a balance sheet. There are two types of assets, current assets and fixed assets. Current assets are assets that can quickly converted into cash. They include cash, accounts, receivable and inventory. The more current asset a small business has, the better, as this means they can survive longer without borrowing money. Fixed assets are physical items that last over a year and have financial value to a company, such as computer equipment and tools. Assets are also categorized as either tangible or intangible. Tangible assets are physically objects that can be touched like vehicles. Intangible assets are resources that have no physical presence through that they have still financial value. Examples include copyright and brand recognitions. Liabilities. Liabilities are everything a business owes now and in the future. They are found on the right side of a balance sheet. A common small business liability is money owed to supplier, accounts payable. All businesses have liabilities unless they exclusively accept the pay with cash. Cash includes physical cash or payment made through a business bank account. There are two types of liabilities, current and long-term liabilities. Current liabilities need to be paid back within a year and include credit lines, loans, salaries and account payable. Many company expenses are current liabilities. Long-term liabilities can be paid back after a year and include mortgages and bonds. Assets versus liability. Assets add value to your company and increase your company's equity, while liabilities decrease your company's value and equity. The more your assets outweigh your liabilities, the stronger the financial health of your business. But if you find out yourself with more liabilities than assets, you may be a cusp of going out of business. For example, assets are cash, investment, inventory, office equipment, machinery, real estate, company-owned vehicles. Examples of liabilities, which is bank debt, mortgage debt, money owed to supplier, wages owed, tax owed. What is liquidity? Assets are often grouped based on their liquidity or how quickly the assets can be turned into cash. The most liquid asset on your balance sheet is cash since it can be used immediately to pay a liability. The opposite is an liquid asset like a factory because the selling process converting the property to cash will likely be lengthy. The most liquid assets are called current assets. These assets can convert to cash in less than a year and including cash, marketable securities, inventory and account received. These assets generate revenue for your company. Non-liquid assets are grouped together into the category of fixed assets. These include real estate, vehicles and machineries. Fixed assets are owed by your company and contribute to the income but are not consumed in the income generating process and are not held for cash conversion purpose. Fixed assets are tangible. Items usually require significant cash outlay and lasting for an extended period of time. Current versus long-term liabilities. Liabilities are also grouped into two categories, current liabilities and long-term liabilities. Current liabilities are those that are due in next year, while long-term liabilities will not be due until at last a year later. Current liabilities typically present money owed for operating expenses such as account payable, wages and taxes. In addition, payments on long-term debt owed in the next year will be listed in current liabilities. For example, if you have 30-year mortgage on your building, the next year's worth of payment owed will be listed in the current liabilities section while the remaining balance will be shown as long-term liabilities. As a small business owner, one of your most important goals will be balance your book. That means you need a solid understanding of assets and liabilities in order to make good decisions and evaluate the health of your business. Once the terms are defined, understanding assets and liabilities is fairly easy, and the financial reports you've been generating will start to have more meaning. Well, if you enjoy this video, don't forget to hit like and subscribe. Be sure to watch, turn on the bell notification so you don't miss any videos just like this one. Please give us your thoughts in the comment below, and we'll see you in the next one. Thanks for watching.